Right, good morning, everybody. It's 11 o'clock, and we've got a lot to get through today. Quite an exciting show. So let's get this round or show on the road. So, as usual, I'm going to run through this week's news, and then we're going to bring on Andrew McHattie to do his sort of review of the month, and we look at the major moves in the investment companies market over June. And then after that, we've got a treat. We've got James Baker and David Horner from the investment company to explain how that works. So, first things first, let's talk about the news sort of this week. Now, so before I jump into that, obviously there's been a sort of major political shift overnight, and I don't think we can do a show like this, which is obviously not a political podcast, as it were. You sort of can't have a transition like this without commenting, but I don't want to get into that too much detail, other than to say, I think this sort of illustrates, just how sort of deep the market in the UK is. I've had a look at the sort of major indices this morning, and literally they've all moved by around 30, 40 basis points upwards. So effectively no change, which shows you, the extent to which the sort of market is effective at pricing these things in. It's all old news. Another thing that I sort of really like, the fact that actually there's not much news this week, which I think is a sort of testament, even though the sort of election etc. was a surprise, and reporting timetables can't be sort of necessarily shifted that easily. The investment company market has quite clearly been sensible, and it's only announced things where it's needed to, which, as I say, there's not been quite, or not been very much at all. Despite that, I've managed to pick out a couple of things that I think are worth talking about. One is an announcement that came on Monday in relation to Tritax Eurobox, and another one is a sort of big NAV uplift that might have got overshadowed by the election yesterday for Castelnau. So let's dig into those. First on sort of Tritax Eurobox, a number of you should know this, probably pretty quite well. It's a sort of £500 million market cap FTSE 250 investment company focused on European logistics assets. Okay, and it's sort of at a fairly chunky discount to NAV, like a lot of these sort of REITs are. It's got a big chunk in Germany, I think around sort of 40%, but the rest of it is in pretty sort of developed Europe. It's quite diversified. It's had a lot of long-term sort of debt in its capital structure, but this was all at pretty attractive interest rates. But as interest rates sort of began to rise, market sort of started to become concerned about this, as it did with all of these assets. And actually, there was a weighty sort of leg down in its basically NAV. So if you looked over the sort of 6 months, 3rd or 31st of March 23, the NAV dropped about 23.9% from €105, down to €105 from 138. And then it went down another 5.9% in the year to 31st of March. So it's now just less or just shy of €1. But I'll sort of show you in a chart in a moment. There's actually a sign that the valuations are sort of stabilizing in the second half of the financial year. It looks like we could sort of finally be at the bottom, which is not surprising where you consider the sort of trajectory of inflation and interest rates now are. As I said before, obviously, its discount widened with the rest of the market due to the higher interest rates, even though actually there was no obvious immediate impact to it. Portfolio was working well, so it did have a lot of debt, but this was sort of quite long dated. But nonetheless, market could see it coming over the horizon and discounted it anyway. And with the sort of decrease in its sort of asset value because of the sort of revaluings, because of the higher interest rates, the LTV moved up quite a lot. And you can sort of see it here, 35% in March 2022. By March 23, 45%. And as I say, there's quite a chunk of debt there. 500 million green bond, as I say, 0.95% coupon, pretty attractive, due in 2026. €200 million US private placement note. Once again, not a high interest rate on this, 1.37% coming in at 2029. So, not an immediate concern, but equally, once you start to add these up and the sort of 250 million RCF, there's quite a bit of debt there. And you can see the impact here. And I think this sort of shows you just how much these things have been discounted not so long ago, so 21 to 22, trading at a premium, and then you really sort of see it go to a discount, and then the asset values come down. But subsequently you can see this stability. And actually sort of more recently, and I'll show in a later chart, you can actually start to see the discount start to narrow up again. Managers didn't sort of sit on their hands, as it were, recognizing the problem, and obviously they had time because of the maturity profile. They put in place a disposal program, and the idea was to sell at least 150 million euros of assets and actually pay down some of the debt, get it down to what I think the market would feel would be a more sustainable level. And I've listed a few transactions there. And you see they're sort of quite chunky, but the sort of key conclusion is actually they did more than 150 million. They did 173 million worth. And it was all basically in line with book value, underpinning the sort of credibility of the NAV. Now, obviously, LTV is still quite high at 31st of March, 44.5%. Now, following the most recent sale, 43.3%. And there were more sales planned before obviously Brookfield came in with its offer, which we'll talk about in a moment. And they were going to bring it even further down, sort of low 40s, and you could see where the trajectory was heading. So sort of 3rd of June, Brookfield Asset Management, this is a big Canadian private equity beast, basically sort of indicated it was in the process of putting together a bid for the company. It had until the 1st of July to make a formal offer. Now, that obviously was Monday. Fast forward to this week, and there's sort of been a bit of news around that. I should say that it follows a fair bit of M&A activity in the sector. We obviously had London Metrics merge with LXI, and obviously, you know, eBox's big brother, Big Box, acquired UK Commercial Property REIT. It's worth noting that, of course, not all of these deals have necessarily gone to plan. Obviously, you know, there were the 2 offers for Aberdeen Property Income that didn't come to pass. And obviously, you know, there's been other similar transactions. Now, as I say, beginning of this week, 2 things happened. The first thing was that sort of Brookfield was given more time to formalise its offer, so it's now got to the 29th of July, so basically the end of this month. But at the same time, eBox said that it was in discussion with a number of parties from whom it either received and or solicited expressions of interest regarding a possible offer for the company. So it appears that Brookfield's offer has brought a number of other interested parties out of the woodwork. I just wanted to sort of show you a shorter term chart here. So you can see the kind of uplift that came in. The sort of NAV's not really moved, but you can see a big uplift in the share price beginning of June, when obviously Brookfield said that it was interested in, you know, buying these assets potentially, and there's been a little bit more recently. But I think if we start to actually see some decent offers, there's some sort of more potential for, you know, uplift from here. As I say, this has been in play for a little while. There has been sort of talk of merger with Asley, which is obviously managed by the same manager. That never happened. It went into managed wind down. You can see, particularly with this deal, but you know, other things going on in the space, that PE or private equity is still taking advantage of logistics sector valuations. You know, these things look cheap on a long-term view, and you know, if you're prepared to be patient, there are certainly some bargains to be had, certainly in their view. There's been lots sort of going on with eBox. Management team that are in place, got a sort of new guy running it. He's good, of good pedigree. He was ex-CIO of Segro. I mean, our analyst Richard Williams, he's with the view that, you know, this guy's steady hand, knows what he's doing, and he knows the sector well. I mean, Richard had a number of conclusions around this, and I think most of us sort of agree with these. Interest rates looks like they've sort of peaked. ECB is sort of cut by another 25 basis point, but you know, sort of signs are valuations are stabilizing, and you could see that in, you know, sort of earlier charts. Just to re-underline, recent sale at book value just underpins the confidence in the NAV, and on that basis, Richard said, you know, he would expect the board to recommend an offer close to NAV. You know, and with a bit of luck, yeah, if you get a possible bidding war, this could push the price up. Now, next thing was sort of Castelnau, and I think this is really, really interesting because it kind of illustrates the sort of value that you can find in some of these sort of private assets. But for those that don't know it, it's in the flexible investment sector. So some people would describe it as a kind of special situations fund. It's relatively new. It's only been around sort of a handful of years. Managed by Phoenix Asset Management, and the way that it's evolved is actually it's now almost a big vehicle for the sort of funeral home dignity. We'll come on to that in a minute. It announced basically its end of June NAV yesterday, and there was a chunky increase. So it increased by 34% to 99 pence per share. That's over the sort of 74 at the end of May. They're sort of quoting 43, I think that was versus a end December valuation. But the main contributor was from Dignity, the funeral services provider. Now, for those that sort of aren't familiar with Castelnau, it owns Dignity through a joint venture with the insurance tycoon Peter Wood, and they basically did a take private deal last year on this. And it's a significant proportion, just over 3/4 of Castelnau's portfolio, or certainly it was at the end of December. And this has had a sort of 45.7% uplift in valuation, and that has obviously had a dramatic impact on the NAV. Now, where has this come from? Well, there has been a sort of revaluation of Dignity's funeral plans trust business, which apparently is a sort of billion-dollar business, sorry, billion-pound business, and it generated a significant surplus. They've also sold some property assets, and that's given them enough money to repay sort of 80 million to bondholders, and that's on top of another sort of 15.6 million they paid in May. And the sort of impact is this is a number of things, but probably the key one is that it improves its sort of coverage of the covenants, and it allows it to reduce its annual debt costs by around £1 million a year. Now, I've sort of not verified this sort of figure, but Castelnau's broker Pamela Liberum said that Dignity had sort of net debts of about 544 million a year ago. So you can see that if you've taken just shy of 100 million out of that, that is a big leg down, and obviously that has allowed them to improve the valuation quite significantly. Elsewhere, obviously, the sort of other 23% of the portfolio, there was some sort of small revaluations downward there, but obviously nothing compared to the uplift in Dignity. And you can see, and it's not very often you see this, but literally, if you look at this chart, this shows you what happened to the share price yesterday. Now, obviously, we didn't know that the NAV had uplifted until yesterday, and obviously that's reflected at the end of June because that's what it is. But really, that's just sort of caught up now, and that's really all I wanted to say about the sort of news this week. Now, obviously, it's time to bring on Mr. McHattie to tell us everything that happened in June. Andrew, take it away.
That's lovely. Thank you very much indeed, Matt. And just on the subject of Castelnau, actually, there's a little bit of a read across perhaps to Aurora Investment Trust, also managed by Phoenix, which has a 13.5% of its assets in Castelnau. So a little bit of an uplift there. Anyway, let's talk about what happened this month. Notwithstanding the market reaction this morning to the election result, which was mildly positive. Actually, it was a reasonable month anyway last month for investment trusts, with about a 1% increase overall in the investment trust index. And there were some pretty reasonable rises, as you can see from this slide, topped by Gresham House Energy Storage Fund, which of course negotiated its offtake deal with Octopus Energy, which was quite helpful. And there were a number of reasonable rises. I think there were a couple of themes that I could pick out from this. One is certainly in the green there, some rises from the depressed renewable energy sector. And in part, that's due to the sector working through, I think, its many corporate issues. So in addition to Gresham House, we had Next Energy Solar report a pretty good asset sale at a premium to its carrying value, and Triple Point Energy Transition, which is winding up, actually is telling us that it had already sold down more than £60 million worth of assets, again at a reasonable price overall. So there's, I think, some improving sentiment around the sector as it works through its reconstruction issues. And of course, Harmony Energy Income Trust, one of the battery storage trusts there, is in a very interesting position because there's potential for a takeover. I think there's quite a lot of interest in its portfolio, so we'll see how that develops. And in the blue here, we have the other, I think, interesting theme of the month, which was that technology keeps marching on, and we've seen actually the momentum continue apace here, led by Augmentin FinTech, which had some decent results. But actually, you've got these large US tech investors on the list as well, and I'll talk about those in a moment. On the way down, there's the one remarkable one at the top, which I'll talk about. Regional REIT, which is having an emergency equity issue, which is quite rare in this sector. But overall, actually, the declines were moderate over the last month, nothing to get too excited about. In addition to regional REIT, I'll just have a brief mention of Greencoat UK Wind, which was down 6.5% over the month. So let's talk about tech for a moment. I'm asked about this quite a lot because I think it's a question with which, many investors wrestle: how much technology exposure you should have in your portfolio. If you do have it, should you continue with it or take some profits? And if you don't have it, is it too late to come in, or, are you missing out on this tremendous run? This is a chart showing you the technology sector index on the NASDAQ. So obviously US stocks here. And this is a 1-year chart, but you can see it's been a very, very strong period for tech. And after a bit of a pause, actually, in the spring, we've seen prices move ahead again. And so this sector really just continues to have very considerable momentum. And in terms of the technology trusts and how they've been performing in share price terms, again, this is a 12-month chart that I've tried to simplify a little. I put four of the leading trusts on here: Manchester and London, which doesn't have technology in its name, but is very much AI focused, has been the leading trust over this period. And then you have Allianz Tech and Polar Capital Tech, very much twinned together, the blue and the black lines there. For quite a long time now, I've found it quite difficult to distinguish between those two. I think it's difficult to recommend one rather than the other. I've generally said you should own both. And then behind it, you have Scottish Mortgage Trust, which of course is not a pure technology trust at all, and probably considered less so now because of its unquoted holdings. But nevertheless, it does have a high-tech component and is often thought of, I think, as a component of this sector. That's also done very well, but actually has flattened off a little bit lately and is on a discount of about 9%. Generally, that's more or less in line with the others here. So you get a bit of a discount on these trusts in spite of their strong performance. So in terms of how you wrestle with this question, I think it's quite a difficult one to answer, because depending on who you speak to, whether they're evangelical about the tech sector or whether they're more value-based investors, you're going to get actually quite polarized opinions. And this is by no means an exhaustive list of bullet points here, but I think it does perhaps represent some of the arguments on each side. On the one hand, you do have, I think, the proponents of the tech sector who are saying, look, this AI revolution is very much in its early stages here. And actually, you've had NVIDIA, for example, as a multi-bagger for some time. Your main risk with that was selling out too soon. And that's the risk now if you consider that tech valuations are a little bit stretched and you're deciding to come out. You could miss out on further gains. And there's no doubting this sector has very considerable momentum at this point. And actually, if you do compare the valuations to 1999 and the peak of the dot-com bubble, the enthusiasm doesn't seem to be quite at the same level. I don't think we're seeing quite the same bubble-like conditions. And essentially, if you do want to have growth exposure in your portfolio, it's quite difficult to ignore tech. I think on the other side of the slide here, the other side of the coin, there are some potential banana skins ahead in terms of regulation, and we've seen France, for example, charging Nvidia with anti-competitive practices. And I think there's quite a valid and widely held belief that this market rally will broaden out at some point beyond those big US tech names, and that there's much more value available elsewhere in different sectors. Ultimately, it's your choice. I think it's wise to have some tech in your portfolio, but I think given its strong run, you'd perhaps be a little bit cautious about adding too much to it at this point. It's an interesting question. Something completely different now on the downside, regional REIT has seen a very sharp decline in its share price over the last month, basically because it's launched this emergency equity issue, which was required because it has a £50 million bond that is maturing in August and needed to be repaid. And it also was lacking working capital. So it needed some fresh money, and it had a look at various other debt options, none of which were attractive at this point. They were all too expensive. And so it's decided to go down the equity route, and it's asking shareholders to stump up actually quite a lot of money. It's £110.5 million. And the offer is completely underwritten by a company called Bridgemere, but it's open to shareholders. And the offer is 15 new shares for 7 currently held. And you can buy the new shares at 10 pence each, which compares to the current depressed market price of about 13 pence. So if you don't take up your rights as a shareholder, you're going to be quite considerably diluted by those new shares. But if you do take up the rights, you've got to find the cash. So there's your dilemma. The dilution is quite considerable here. The NAV is going to come down to about 24 pence a share. The dividend is being reduced, although that's a slightly complex calculation, actually, that I've talked about in my newsletter this month. But the dividend's being reduced. And I think it's not necessarily an easy question for shareholders. But my sense is that if you have the cash available, you should avoid dilution of your current shareholding, because undoubtedly the shares post the fundraising, which will go ahead because it's underwritten, the shares are going to be on a very big discount, probably 50%. And the yield that's forecast for next year, once it's been properly reset, the dividend yield is going to be about 10%. The shares are going to be consolidated on a 1 for 10 basis. And I think the debt reset does allow the trust actually to move on with a firmer footing here. It's still investing in offices. And so I think ultimately your real decision is to determine whether the office real estate sector is likely to bounce back or not from its current difficulties. And in part, of course, that depends on benign economic conditions. So we'll have to see what our new government produces in that way. Just before I leave that topic, I noticed a question about the sectors that might benefit from a Labour government. It's hard to tell. Obviously, it's early days, and manifesto promises are not necessarily translated into actual policies in the real world, are they? But I think it's commonly thought, actually, that the renewable energy infrastructure sector could benefit. We might see a bit more infrastructure spending, although, of course, the new chancellor is going to have to wrestle actually with the tax burden and the amount of room she has to create new spending plans. So I think it's early days. House building, I think, is another sector that's widely expected to benefit. And it could be that there's some knock-on effect in the property sector that could help regional REIT, but I think it's a bit early to say. The last trust I'll talk about is Greencoat UK Wind, where I've noticed actually an expansion of the discount. It's come out to about 18% following the 6.5% share price fall over the last month. You can see the share price fall on this chart pretty clearly. You see the NAV of the green line here, which steps down occasionally because of the quarterly dividend payments. It has been edging a little bit lower, which is primarily on power price assumptions and also, of course, on the discount rate. But nothing very dramatic has happened with the NAV, but we've seen the shares come off, and the discount chart on the bottom here doesn't show it very clearly, but the discounts widened a fair bit of late. And I think this is interesting because Greencoat UK Wind, to my mind, is really considered one of the blue chip components of the sector. And because of its size, being the largest trust in the renewable energy sector, it's the most widely held, certainly by institutions. And it's a highly regarded trust. So I do think it's notable when the discount comes out. And this current level of 18% compares to a 12-month range between about 7.7 and 21.7. So it's definitely at the wider end. Now, the trust is in the midst of a share buyback program. If you look at the RNS feed, you'll see that it's buying back shares virtually every day at the moment. And so it is trying to support the share price to some degree, although we could have a whole different debate about the impact of share buybacks, of course. The trust is sensitive to power prices, and that could account for some of the weakness. But I think really the next major item of news we're going to get here is the results announcement, which is due on July 24th. And generally speaking, I think most of the results that have been coming through of late in the sector have been pretty reasonable, showing flat to marginally negative NAVs. Actually, some have been increasing. I'm not expecting much dramatic news from Greencoat UK Wind, but I do think that perhaps this combination of liquidity, high reputation, and I think a decent sector with the prospect of interest rates coming down later in the year, I think those actually combined with this 18% discount make this trust worth looking at. Okay, with that, that's the end of my section, and there are no more questions, so I'll hand back to you, Matt. Thank you.
Thanks very much, Andrew.